Welcome to 2 Minute Accounting. Now what you need to learn, I'm just going to tell you the basics of bookkeeping. Now with every transaction there's going to be a debit and there's going to be a credit. Now whenever there's a transaction, you've got to decide what the debit is and what the credit is. Now the best way to learn this is learning these acronyms. You've got an acronym called DED on the debit side. And on the credit side, you've got an acronym called CLICK. Now, what that means is that debits increase when you have an increase in expenses. So, if you have an increase in expense, it's a debit. If you have an increase in an asset, it's a debit. If you have an increase in drawings, it is a debit. On the credit side, credits increase liabilities. So if you have an increase in liability, it is a credit. If you have an increase in income, it is a credit. If you have an increase in capital, it is a credit. Now the vice versa is true, because if you reduce expenses, reduce assets and reduce drawings, then it's a credit. And on the other side, if you reduce liability, reduce income, reduce capital, then it's a debit. Now an expense is something that reduces your profit, therefore it's a debit. An asset is something that you own that belongs to you, therefore it's a debit. Drawings is something that is taken out from the business, and therefore it's a debit. Now credits, you've got a liability, something you owe someone, therefore it's a credit. Income, another name for sales, it's going to be a credit. And capital, it's what the money that is invested by the owner is a credit. The reason that capital is like a liability, because the money that is invested in the business by the owner, then the business, which is a separate legal entity, owes that money to the owner. Thank you for listening to 2 Minutes of Accounting. Hopefully you understand a bit better debits and credits.